Alright, welcome everybody to the After Hours channel. Today we have an important topic to discuss that concerns all investors out there. We'll be talking about investor greed and how it can lead to significant investment losses. So, if you want to safeguard your hard-earned money, stay tuned to the end of the video. So before we get into the main part of this video, we always start things off with a portfolio update. I know it's been a few weeks since I put up a video. I apologize for that. I've had a lot going on recently, but let's take a look at how the portfolio has been performing lately. So if we look at the one-day view, we can see that the portfolio is actually down roughly $700 and sitting at $133,000, almost $134,000. Moving to the 1 week view, we can see the portfolio is up 1.7% or $2,200. Taking a look at the 1 month view, we can see things are starting to ramp up pretty quickly. The portfolio is up roughly 5% or $6,200, so things are definitely starting to look good. And as many of your portfolios, I imagine, probably look the same way, if we're taking a look at the 3 month view, we can see that my portfolio is up 13.3% or almost $16,000. This was one of those times where it paid to be invested in the market. And lastly, if we take a look at the year-to-date performance of my portfolio, we can see that it is up $30,000 or 29.4%. So make no mistake about it, I am extremely happy with this performance. This has been my best year investing so far, and it's all due to a few investments that I made a few years ago that I took a bet on. Now, unlike other channels out there, I won't make you guys wait to tell you which companies those were or which stocks I bought that were bets in my opinion. So you can see it on your screen right here. One of the biggest bets that I've made is actually Microsoft. I've been buying into this company for quite a few years now, building up my stake every single month. And because of that, you can see down here at the bottom that my market value in this holding alone is almost $40,000. Total returns for this one holding is $11,000 or 40%. Just over here to the right, we can see that my average cost for buying into this company is $249 per share, and it actually makes up 29% of my total portfolio. So as we'll get into later in the video, we'll talk about concentrations or overconcentration and how that can be a risk for some portfolios or some investors out there. But in this case, I feel completely comfortable putting this amount of money in one company. If you want to see my deep dives on Microsoft over the years, pretty much go click on any video I've ever posted, and I probably talked about it. The second company that I considered a bet that I was buying into for a few years as well, and that is actually Apple. As you can see, the year-to-date performance has been incredible. It's up almost 50% or just under 50%, and it's trading at $195 per share. Taking a look down here at the bottom, we can see that my total market value for this position is actually $26,000, and I have an $8,500 return, which is 48%. Now, I definitely wish I invested more money into Apple because it has a higher performance than the Microsoft holding you see. Moving over here to the right, we can see that my average buying cost for Apple is actually $131 per share, and the total portfolio diversity is actually 19.5%. So this holding alone makes up 19.5% of my total portfolio. Now, with that out of the way, let's get into the main portion of this video, which I'm going to split up into 4 different segments. The first segment we're going to cover is what is investor greed. Investor greed is a common psychological trap that many investors fall into. It's a strong desire for higher and quick returns, often driven by fear of missing out or FOMO on potential profits. While ambition is essential for financial growth, excess greed can lead to making irrational investment decisions. If you're unfamiliar with what we're looking at right now, this is actually the fear and greed index. This gives us a little insight into the overall pulse of the market and overall investors on whether they are greedy, extremely greedy, or extremely fearful. So taking a look right here, we can see that in today's market, investors are in the extreme greed category. Now, this could be detrimental for quite a few reasons that we'll talk about in this video, but historically, I do want to point out that on average, when investors are in this category, markets tend to drop off very quickly, which results in a lot of investors losing a substantial amount of money. One portion I want to take a look at real quick is actually right here. So you can see it down at the bottom. This was updated on July 20th, which is only a few hours ago. Starting at the very bottom, it says 1 year ago, we were in the fear category at roughly a 44. Now, if we take a look at the S&P 500, we can see that if we bought in during that time frame, we would have made a substantial amount of money. We would have done well in the market. As of 1 month ago, we were in the extreme greed category. 1 week ago, numbers bumped up a little bit, went from 79 to 81, and as of today, we're at an 82. So it seems like every single day, if not every week, this index is creeping up further and further to that 100, which is the max extreme greed. Now, if we rely on some of the best investors in the world, if not the best investor in the world, we can get a little bit of wisdom that will help us understand that chart we were just looking at. So in this first sentence, Warren Buffett once said that it is wise for investors to be fearful when others are greedy and greedy when others are fearful. And as I mentioned earlier, that historically has always been the case. So when I see year to date that my portfolio is going up 30%, the hairs on the back of my neck start to stand up, because that one quote from Warren Buffett starts to ring true in my ear that, hey, maybe these valuations are undeserved and it's time to start taking some profits. This leads me to the second segment of this video, and that is the downside of investor greed. Number one on that list is going to be chasing unreasonable returns. One of the biggest mistakes driven by greed is chasing unreasonable returns. When investors hear about friends or acquaintances making massive profits from a particular investment, they might become desperate to replicate those gains quickly. However, it's critical to remember that every investment comes with its own set of risks and rewards. What worked for someone else might not work for you, and blindly following hot tips or speculative trends can lead to financial disaster. Case in point, we have AMC. Everybody remembers when this stock was racing up like crazy, and granted, I'm sure a lot of people out there, or I should say a little bit of people out there, the minority, not the majority, made a substantial amount of money, whereas the majority lost a substantial amount of money. So when we're talking about chasing unreasonable returns, this is exactly what that looks like from a visual perspective. The stock goes from trading at $2 and starts trading at $50 within the matter of months. Whoever bought in at the bottom makes an incredible amount of money if they can time it perfectly. And of course, whoever bought in at the top lost everything. If those investors would have simply taken the time to look at this company's free cash flow over the years, they would have known this is a terrible investment to make. But they let their fear of missing out dictate their investment decisions, and well, you saw the result in the other chart we looked at. A lot of people lost a considerable amount of money. This leads me to my second point, and that is ignoring risk factors. When greed takes over, investors often overlook or downplay the potential risks associated with an investment, hence what we just looked at, the free cash flow and the EBITDA of AMC. They become fixated on potential rewards, losing sight of the probability of failure. This can include ignoring warning signs about the company's financial health, overlooking market volatility, and disregarding regulatory uncertainties. Such negligence in risk assessments can leave investors vulnerable to unforeseen events and significant losses. Now, I hate to constantly beat up on this stock, but it's a prime example of what can happen when you're investing in a hype market and you're buying into hype stocks. Taking a look at the cash flow section, their free cash flow is negative 11%, almost 12%. Looking at the overview of their margins and growth, we can see that their profit margins are negative 21%. That is a clear indication that this company is not making money. And if we simply look at the balance section, we can see that AMC has roughly $495 million on hand, but they are in debt $4.7 billion, which nets out to $4.2 $1.25 billion in debt. This leads to the next point I want to make, and that is overconcentration in high-risk assets. Greed might lead investors to concentrate too much of their portfolio in high-risk assets. While these assets can offer the potential for high returns, they also come with increased volatility and vulnerability to market fluctuations. Overconcentration in a single stock, sector, or speculative asset set exposes investors to unnecessary risk. A well-diversified portfolio, on the other hand, can help mitigate potential losses if one investment underperforms. Now, I'm not going to pull up any articles or pull up any different companies to explain this one point I'm trying to make because, unlike other channels, I am all about transparency. I want to show you guys exactly what I am buying, what I'm selling, and how the performance of my portfolio is doing. With that being said, the immediate question that I imagine comes to your mind is you're talking about overconcentration in high-risk assets, yet you have 30% of your portfolio in Microsoft alone. And my immediate rebuttal to that would be, I do not consider Microsoft a high-risk asset, and I will show you exactly why. When I purchase any company and I consider putting it in my portfolio, make no mistake about it, I do a considerable amount of research. And if I had to choose one stock in my portfolio that I have probably done the most research on, it is Microsoft. Now, just like Apple, Microsoft, Visa, or any of the other companies I own, I do not consider them high-risk assets, and here is why. We take a look at Microsoft's revenue since their inception, and it is basically parabolic. The management team at Microsoft and their executives know exactly how to keep this business running without over-leveraging themselves, hemorrhaging cash, and diluting me as the shareholder. If we take a look at their free cash flow, which is arguably one of the most important metrics to look at, and it resembles the revenue. This company is extremely cash rich. As we can see, in 2022 alone, they made $65 billion. If we factor in stock-based compensation to that, we can see that they made $57 billion. So they are still extremely cash rich. While Microsoft doesn't pay the biggest dividend, it is consistent, and that is what I'm looking for. A company I can rely on to consistently pay me without doing dividend cuts. Their outstanding shares are going down, which means they're doing stock buybacks, which artificially increase the price of the stock itself. And lastly, their returns on capital employed look incredible in my opinion. If you're unfamiliar with what this is, we'll use last year as an example. So we can see return on capital employed is 30%. That essentially means if Microsoft invested $100, they got $130 in return. That's a clear indication that this company knows how to make money on the money that is invested. So when I'm giving Microsoft $30,000 of my income, I know that they're going to return some of that money to me as the shareholder. This leads me to my next point, and that is neglecting due diligence. Due diligence is the backbone of successful investing, but greed can tempt investors to skip this critical step. When potential profits seem too good to resist, investors may fail to research the investment thoroughly. This lack of proper investigation can lead to investing in fraudulent schemes, Ponzi schemes, or unsuitable businesses. Remember, the more informed you are, the better equipped you are to make sound investment decisions. So when I tell you guys I have thoroughly researched every single one of my holdings in this portfolio, I mean it. I have done my due diligence. Now, make no mistake about it, that doesn't mean that every single one of these investments is going to pan out in my favor. There are always unforeseen circumstances in the market, and that is just the cost of doing business. As I mentioned earlier, this is a calculated bet, make no mistake about it. But when I'm considering making a bet, you can bet I'm going to do everything I can to skew the odds in my favor to work out. Hence, taking a look at the financials of any company that I'm going to put my money into. Last on the list, and that is emotional decision making. When driven by greed, investors are more likely to make emotional decisions rather than rational ones. Fear of missing out on an opportunity or anxiety about losing out on potential gains can cloud judgment. As a result, investors might impulsively buy into an investment when prices are soaring or sell when the market takes a downturn, locking in substantial losses. Emotional trading can disrupt long-term investing strategies and harm overall financial well-being. A quick Google can pull up hundreds, if not thousands, of articles describing this exact thing I'm talking about. 2/3 of investors regret emotional, impulsive investing decisions. 2/3 of them. Let that sink in. Another critical piece of advice that is always echoed by Warren Buffett is he leaves emotions out of investing. And if you look at his performance over the years, it looks like it's working out. For the next segment of this video, let's take a look at some real-life examples of investor greed leading to investment losses. I imagine none of these will be a shock to anybody. They're pretty well known, but the first one we have is the dot-com bubble of the early 2000s. During the dot-com bubble, investors were eager to invest in any internet-related companies regardless of fundamentals. When the bubble burst, many companies crashed and investors lost a substantial amount of money. Next, we have the real estate bubble of the mid-2000s. In the mid-2000s, the real estate market saw a tremendous surge and investors rushed into buying properties with the expectations of a quick profit. However, when the bubble burst, property values plummeted and countless investors faced foreclosure and financial ruin. Now, I bring these examples up not to say that history will always repeat itself, but there's a famous saying that goes along the lines of if you don't understand your history, you're doomed to repeat it. Now, moving on to the last segment of this video, and that is how to avoid the trap of investor greed. Number 1, set clear investment goals. Define your investment goals, risk tolerance, and time horizon. Having a clear plan will help you resist impulsive decisions driven by greed. As for me, I am a long-term dividend investor. I know that I want to be invested in the market for at least 20 years. So I make sure that the companies that I buy are companies that I think will be around in the next 20 years. Second on that list, and that is stick to a diversified portfolio. Diversify your investments across different asset classes or industries. This can help spread risk and reduce the impact of a single investment's poor performance. Now, I understand if you think I may not be the best candidate when I'm talking about diversifying your portfolio, but you have to think, I have a lot of ETFs in this portfolio as well. So even though I have large stakes in companies like Apple and Microsoft, I also have large stakes in ETFs like SCHD, where if we look at my total market value, we can see that I have in this ETF alone $22,000. So make no mistake about it, I try to offset the volatility and potential losses of my portfolio as well, following the same criteria and steps. Next on the list, we have conduct thorough research. Always perform due diligence before making any investments. Understand the company's financials, market conditions, and potential risk involved. So if you're going to buy into a company, understand their competitors. Understand where they sit in that hierarchy of companies within their same field. And always take a look at their financials. There are very sneaky companies out there that like to hide losses in their company or disguise profits when in fact they're actually losing money or they're paying their executives extremely large stock-based compensation bonuses. Lastly, on that note, I always recommend taking a look at their outstanding shares. You want to see that these charts are heading down. Down when you're looking at this is good. If this is going up, that means that they are issuing new shares, further diluting you as the shareholder. And lastly, have an exit strategy. Determine your exit strategy for each investment. Knowing when to cut your losses or take profits can help you avoid emotional decision making. Remember, while ambition and optimism are great qualities for investors, unchecked greed can lead to disastrous outcomes. Stay disciplined, be patient, and follow a well thought out investment strategy. I hope this video has shed some light on the importance of avoiding investor greed to protect your wealth. If you found this video helpful, don't forget to give it a thumbs up and don't forget to share it with a fellow investor. Thanks for watching. I'll see you all in the next one. Take care.